Welcome to video 1 of part 1 of the EA Tax Training free EA exam prep course for 2025. My name is Tom Norton. I am both a certified public accountant and an enrolled agent, and I will be your guide and instructor throughout this course. Before we get started, I would like to point out that you can get a free copy of the slides for this video and for all the videos in this course. In the description of each video is a link where you can have a PDF of the slides for that video emailed to you. Part 1 of the EA exam is all about individual taxation. We've got 7 videos for you in Part 1. This first video you're watching now we call Overview and Getting Started. Video 2 is all about income. Video 3 is about a special kind of income called capital gains. Video 4 is about adjustments and deductions. In video 5, we'll talk about calculating the tax and tax credits. Video 6 is all about retirement accounts and Social Security. And finally, video 7 is about specialized returns and topics. One important point about the 2025 exam and this course. The 2025 EA exam, officially known as the Special Enrollment Examination, or SEE, is based on the 2024 tax law. Specifically, it is based on the law as of December 31st, 2024. So that is what we will be dealing with in this course. I look forward to guiding you through all of these topics. So without further ado, let's jump right into video 1, Overview and Getting Started. In this video, we're going to do an overview of the individual tax return and the individual tax system in general, and we'll talk about what you need to do in getting started to prepare a tax return for a client. Specifically, what we'll cover is an overview of Forms 1040 and 1040 SR. Then we'll talk about the sources of information you need in order to do a tax return. Then we'll talk about the filing requirements and due date. Who's even required to file a 1040, and if so, when are they required to file it? And then we'll go into detail about specific items in the top section of the income tax return: the Social Security number, tax residency, filing status, dependents, and the check boxes. First, near the beginning of each of these videos in the course will be a slide like this one where we've got free resources from irs.gov. You can go out to irs.gov and download a PDF of each of these and use those to study along with these videos. And here's a pro tip about the EA exam. It is based primarily on IRS publications, forms, and form instructions. So that is mostly what you are going to see here. You don't necessarily need every one of these that is listed here. So what I've done on each slide is put into bold the ones that are most important for you to see. In this video, you can see the top 2 are in bold. So let's talk about these. First of all, Publication 17, Your Federal Income Tax. I consider this to be the textbook for all of Part 1 of the EA exam, not just this first video, but all of Part 1. You will definitely want to get and read and study Publication 17. And if Publication 17 is the textbook for Part 1, then Form 1040 and the instructions to Form 1040 is the workbook for Part 1. So you will definitely want to check out the form as well as its instructions. And then you can see the rest of these items that are listed here. They are all great as well. I encourage you to check them out, but they're not absolutely necessary. And I know you've only got so much time and so much energy. So if you're going to focus on something, focus on those that are in bold. But if you're looking for more information about any of these topics, then you can check out those forms and those publications for information. So now let's start by doing an overview of the 1040 and the 1040 SR. Before we look at the forms themselves, let's look at an overall flow of the tax return. So this is kind of a big picture look at what we're trying to do. When we're doing a tax return, we're trying to ultimately figure out, does the taxpayer owe the IRS money, or do they have a refund that is due? So that's what we're trying to get to. But in order to do that, we need to go through all of these steps. So we're going to start up here with what's called gross income. So think of that as the total income of the taxpayer. Then we're going to subtract something called adjustments to income, and that's going to leave us with a very important number called adjusted gross income, or AGI. You're going to want to focus on this and remember this number because many areas of the tax law refer back to AGI. So it's a very important kind of checkpoint along the way of doing the tax return. Once we have adjusted gross income, then we're going to subtract deductions. You're going to have either standard or itemized deductions. And then some people will have something called a qualified business income deduction as well. Once we subtract those deductions, that leaves us with taxable income, obviously another very important number. Then we'll take the taxable income and we'll figure out our tax. And the way we do that is we use tax tables or we apply tax rate schedules. That then gives us the amount of the income tax. But we're not finished yet because some taxpayers will have tax credits that they can subtract from their income tax. And some taxpayers will have other taxes that they need to pay in addition to their income tax. And so once we subtract the credits, add the other taxes, that leaves us with a total tax. Then we're going to subtract any tax payments that have been made. So this could be something as simple as withholding from a job that's shown on a W-2, or it could be estimated tax payments that have been made, or other types of payments that have been made. And then once we subtract the payments from the total tax, that will then leave us with the amount due to the IRS or the overpayment or refund due from the IRS. So how does this actually look on the tax form? Well, let's have a look at the Form 1040. This is page 1 of the Form 1040, and let's zoom in here so we can get a better look at it. At the top, again, in this video, we're going to go into much more detail about all these things at the top, but it's got your basic information to identify the taxpayers, choose your filing status, etc. And then you're going to get down into the income. Remember, we talked about gross income being at the top of that flow chart. So that's what you're going to have is the various types of income are going to go here. And then you are also going to have various adjustments to income, which is going to lead us down here to line 11, which is that very important number, that adjusted gross income. Then you're going to have either your standard deduction or your itemized deductions, the qualified business income deduction, and that is going to leave you with your taxable income here. It's the last line on the first page, line 15, is that taxable income number. Then we're going to go over to page 2, and we are going to determine the amount of our tax. And we're going to have some credits in here, some other taxes. That's going to leave us with our total tax. Then we've got our payments and the various types of payments, which will leave us with our total payments, which finally then tells us how much either the taxpayer overpaid, so they get a refund, or how much they owe. You can see there is a place here on the return that the taxpayer, if they want to have that refund put straight into their bank account, they can put their routing number and their account number right here, and the money will be deposited right into their account. And then we'll get down under these refund and amount you owe. You have something called the third party designee. And this is where you can put your name and phone number. And as long as the taxpayer agrees, then if the IRS has a question about this particular tax return, the IRS knows that they can talk to you about it. So they don't have to talk to the taxpayer themselves. You can talk to the IRS on their behalf. We'll get much more into how all of that works in part 3 of this course. And then finally at the bottom are the signature blocks. So this is the signature block for the taxpayer as well as for you as the paid preparer. And then it's important to see that here under penalties of perjury. So anytime the taxpayer and you are signing a tax return, they're doing so under penalties of perjury. And again, we'll talk more about that later in this course. So that is kind of an overview of Form 1040. Now, of course, there can be many more pages and there can be schedules and other forms that get attached to the 1040, but this is the basic 1040 itself. So now let's look at another form. This is called the 1040SR. The SR stands for seniors. So this is a form that is designed for taxpayers who are age 65 or older. And the only substantial difference between this form and the 1040 is that the font is larger. So it is designed for older taxpayers who appreciate a larger font size so that they can see it better. So you can see it starts, it's all the same information. Nothing here is any different than it is on the regular 1040. All the amounts are going to be the same. The standard deductions are going to be the same no matter which form you use. The tax that you owe is going to be the same. So none of the actual numbers change. It's just that the font is larger. So instead of doing everything on 2 pages, it takes 3 pages in order to get through it all. And then they do add a 4th page here, which just shows a chart of the standard deduction. So this is just for the convenience of the taxpayer that they don't have to go and look up somewhere how much the standard deduction is. It's shown to them right there on page 4. Now, in the real world, when we're doing tax returns, the vast majority of income tax returns are filed electronically these days. So, does the font size really matter if you're filing it electronically? Well, not all that much. But to be fair, of all the tax returns that are filed on paper, it's fair to assume that a large percentage of those comes from this population of folks who are age 65 and older, because that's the way they've always filed their tax return. That's what they're comfortable with. So many of them will continue to file on paper. And so this Form 1040SR can be a convenience for them. But if you're doing tax returns, of course, you're going to be using tax software. You're going to be filing electronically. So it's probably not necessary for you to use the 1040SR, even for your taxpayers who are seniors, but you can do so if you want to. But just know that it is voluntary. It is not something that you have to do. Moving on now to sources of information. So if you're going to prepare a tax return, of course, you need to be able to get the information that you need in order to do the return. So where do you get that information and what kinds of information are you looking for? Well, your starting point, the very best place to start is with last year's tax return. You want to see the prior year tax return if at all possible. First of all, it's going to have the basic taxpayer information, names, addresses, social security numbers, etc. Of course, you're going to want to verify all that because things do change, especially addresses, but at least it gives you a starting point. It's also going to give you a good idea of what to look for this year. Taxpayers tend to have the same sorts of things from years to year. So if they had a W-2 and 1099 or any K-1s or anything like that, they had those last year. It's likely they're going to have the same sorts of things this year. So it's good to be able to know what you're looking out for. And there's going to be some things that do carry over from year to year. You're going to have things like net operating losses and different kinds of carryovers. There can be depreciation which goes from year to year. So it's very helpful to have that prior year's tax return to be able to look out and compute those things. And then finally, it is good for you and the taxpayer to compare, once you're finished with this year's return, to compare it to last year's return. So it can help you as the preparer find things that you might have missed. And it can be good just to be able to see, okay, this year you made this much money, last year you made that much money, and to compare and see those things and how they change from year to year. Now, what if you don't have access to last year's tax return? Well, that is okay. You can still do the return. You don't absolutely have to have it. It's just nice to have it. So if you can get it from the tax preparer, or obviously if you were the tax preparer last year, then you'll have it, then it's a great place for you to start. What if, when you're looking at that last year's tax return, you discover that there was an error that was made? The previous preparer made an error, or maybe even you made an error. Hopefully not, but it does happen. So if you're looking at last year's return and you notice an error, then you do need to tell the client about it, and you need to explain the consequences of that error. Now, obviously, the error could go either way. It could result in the taxpayer owing more money, or it could result in them getting a bigger refund. So either way, you want to tell the client about that, and you want to explain, here's what happens. For instance, if they owe money because of the error, then you want to explain, all right, you're going to owe about this much money, and there's going to be penalties and interest on top of that. Or if they're going to get a refund, then you want them to know, here's how much refund approximately that you would get, and that you would get interest on that. That's right. If you have a refund due, the IRS will pay you interest on the amount of that refund back from the time that you should have gotten it. So you should have gotten it last year. You didn't, so they will pay you interest on that up and through the date that they send you the check for the refund. But you explain that to the client, and then ultimately it is the client's choice about whether or not to amend last year's return and whether or not to fix it. It is not your choice. They will make that determination, and then you will abide by that. If they choose to amend it, you do so on a Form 1040X. And again, we'll get much more into that in later videos. But the main thing to remember here is that it is not your choice, it is theirs. And if they decide not to amend it, you do not go off to the IRS and say, hey, they didn't amend their return. There is confidentiality between tax preparers and clients. So it is not your job. As a matter of fact, you are not allowed to just go running off and tell the IRS or anybody else that they need to amend their return and they haven't done it. That is not your job. Now, if we're talking about things like fraud or having committed a crime, we could have a different set of rules that comes into play, and we'll talk about all that later, mostly in part 3 of the course. But if it's just a routine error, and routine errors get made all the time, then client decides whether or not to fix it, and you abide by that choice. Okay, so now let's talk about the sources of information and what your responsibilities are. You are expected to do what's called due diligence for the information that you get from a client, but you are not an auditor. You do not work for the IRS. You are not going to ask your client to prove everything that they tell you or to prove every single number on the tax return. You're going to look at the various items, and you are just going to apply what I'm going to call a reasonableness standard. What would a reasonable, well-informed tax preparer do with this information? So if they are telling you that they've got a certain deduction and it makes sense, it seems like it's reasonable based on that particular client's life circumstances, the amount of their income, et cetera, and so forth, then there's no reason for you to question that or to make them prove it or anything like that. What you would be looking for is something that just doesn't pass what we call the smell test, something that just doesn't seem quite right. So to give you an extreme example, let's say you had a 30-year-old who has a job and they make $50,000 per year. They don't have any dividends or interest. There's no evidence that they've got a large investment account or anything like that. And they tell you that they made a $40,000 charitable contribution last year. Well, is it possible that they made a $40,000 charitable contribution? Sure, it's possible, but it doesn't seem likely. They make $50,000 a year. Doesn't look like they got any big investment accounts. How exactly would they be making a $40,000 charitable contribution. So that would be one where you would say, you say you made this charitable contribution, and that's great, but that might raise a bit of a red flag with the IRS. So explain that to me. What was that contribution? And do you have like a receipt or some evidence for it? Things like that. So things that just don't seem quite right, you are going to want to ask questions about. But if it seems normal and it seems to make sense, then you do not need to question it. Now, there are some things that the IRS actually does say, no, you as the preparer, you do have to get proof. You do have to get more information. We'll talk more about those later in the course. But for the vast majority of things, that is not the case. So, what types of items do you need to even get information about? Well, it's all the things that might be on the tax return. So, things about income, expenses, credits, the basis of assets. So, if the taxpayer has sold assets during the year, then you need to know how much the gain or loss is on the sale of that asset. In order to do that, you need to know how much the taxpayer paid for that asset. It's something we call the basis of that asset. And then there's other items on the return also that you will want to get information about. So let's look at each of these specifically. So when it comes to income, you're going to be looking for the taxpayer's worldwide taxable and non-taxable income. You want to get a good picture of their total income. So you'll be looking for certain types of things. W-2s, which if you've ever had a job in the United States, you probably know what a W-2 is. That's what the employer sends you at the end of the year, shows you what your salary was, your withholding, et cetera, and so forth. So lots and lots of taxpayers, of course, will have W-2s. They may also have 1099s. A 1099 will report certain types of income like interest and dividends and what's called non-employee compensation and other types of income. So you can look for those. There can be K1s. K1s will come from subchapter S corporations. They'll come from partnerships. They'll come from trusts and estates. They will show various types of income, so you can look for those. You might also be looking at bank or brokerage statements and the taxpayer's own records. Maybe the taxpayer has a business and they've got bookkeeping records or receipts or spreadsheets that they keep, things like that. So all those types of things you can look for in order to figure out how much income the taxpayer has, and there can be other items as well. When it comes to expenses, we can have things called 1098s. 1099s we talked about for income. 1098s can show different items of expense. So, for example, if the taxpayer has a mortgage with a bank, they will get a 1098 showing the amount of mortgage interest. There can be 1098 that come from a college or a university showing tuition paid, etc. So, different types of 1098s can show different types of possibly deductible expenses. And then those K1s that we talked about when we talked about income, K1s can also show types of deductions and amounts of those deductions. And then there can be receipts that the taxpayer has and bank statements, canceled checks from checks they've written, and again, the taxpayer's own records, etc. Assets, again, we need to have some information about assets, particularly once they are being sold. So you want to know the cost or basis of those assets. So if it's real estate, they will likely have a closing statement. So if they bought a house, for example, there will be a closing statement. You'd like to have a copy of that. Bank or brokerage statements can help to understand stocks and bonds and mutual funds. There can be certain forms that were issued to the taxpayer. Again, 1099s can help with this. K1s again. And then there's this form 3922 that they might have if they had stock options from an employer. Again, there could be receipts when they purchased an asset or canceled checks. There can be appraisals of various types of assets and other information to give you information about those various types of assets. And then other information on the tax return, there can be letters that they got from the IRS. So let's say last year the taxpayer filed their return And then the IRS discovered an error and they sent a letter and they said, we've made an adjustment to your return. And now your adjusted gross income is this much, your taxable income is this much, your tax is this much. You will want to obviously have a copy of that letter or any other letter that the client got from the IRS. You always want to ask, did they get any type of correspondence from the IRS? And if they did, you would like to see a copy of that. Things like school records, if you're dealing with children and with various tax credits related to children, sometimes it can help to have their school records to establish that, yes, they have this child and that they're a certain age, etc. Something as simple as a driver's license. If you're dealing with a taxpayer, they walk in off the street, so to speak, you have no idea who they are. Well, there's a lot of identity theft and tax fraud that goes on. So you're going to want to know who you're dealing with. So you want to ask them for at least one form of official identification. So you might get a driver's license and take a copy of that. And there could be other things that you would ask for depending on the circumstances. So now let's talk about filing requirements and due dates. So who is required to file a return? So when we talk about this 1040, who needs to file it? Well, here it is. If you are a U.S. citizen or resident of the United States or Puerto Rico, and you meet the filing requirements, then you need to file a Form 1040. And the filing requirements are going to be based on income primarily or other. So there are some other things that, regardless of your income, you still have to file a 1040. But for most taxpayers, there are minimum amounts of income that you need to have before you need to file a tax return. So this is it. If you are a U.S. citizen or a resident of the United States or Puerto Rico and you meet those minimum filing requirements, then you need to file a Form 1040. So you will want to know that for the EA exam. Now, it is also important to point out that some non-residents that have US-based income will also need to file a return. They don't file a regular 1040. They file this other return called a 1040NR for non-resident, and we'll look at that a little bit later. But for most taxpayers, this is who needs to file the Form 1040. When we are looking at those minimum amounts of income in order to file, we need to understand a few basic definitions of types of income. We're going to get into much more detail about income in video 2 of part 1 when we'll talk specifically about income. But for now, we need just to understand these basic definitions. So first, gross income. So this is all income received in the form of money, goods, property, and services that is not exempt from tax. So that is what gross income is. And it includes income from sources outside the United States as well as inside the United States. It could include income from the sale of your home. It includes the taxable portion of Social Security benefits. It includes your business gross income, but not losses. And it includes capital gains, but not capital losses. So all of that is gross income. And then when you have your gross income, it is going to be broken down into two different general types: earned income and unearned income. So earned income includes salaries, wages, professional fees, tips, business income from a business that the taxpayer has, etc. So those things are kind of intuitive. The one thing that maybe isn't intuitive is taxable scholarships and grants are also included in earned income. So it maybe doesn't seem like earned income, but it is included for these purposes. Unearned income then is everything else. So this would include taxable interest, dividends, capital gains, unemployment compensation, taxable Social Security, pensions. Now you might say, but wait a minute, I worked for that Social Security or I worked for that pension. And that is true. You worked for it in the past, but you didn't work for it this year. So it is considered unearned income now. And then things like annuities and distributions of unearned income from trusts. So when you take your earned income and you add it to your unearned income, then that is going to equal your gross income. So just keep these things in mind as we look at some of these charts and definitions that we are going to see. Speaking of charts, here's the first one we are going to look at. So this is the 2024 filing requirements for most taxpayers. So we're going to look next. The next chart we'll look at is for the people that this does not apply to. But for most taxpayers, this is the chart that will apply. By the way, this chart comes straight from publication 17 that we talked about at the beginning of this video. So this is showing who has to file a 1040. So it's based, first of all, on your filing status, single, married, filing jointly, etc. We're going to talk about those more in this video, but for now, just take it for what it is. There are these 5 filing statuses. So based on the taxpayer's filing status, and then whether or not they are under or over age 65, these are the minimum amounts of income that they need to have in order to be required to file a tax return. So, for example, if you're single under age 65, then if you have $14,600 or more of gross income, then you must file a Form 1040. If you are age 65 or older, then that amount goes up to $16,550. And then you can see the others for all the different filing statuses. If you are married and under 65, then it is $29,200. Not coincidentally, that is twice as much as the single amount because there are 2 people involved instead of just one. And then you can see the amounts if you are over age 65. If you are married filing separately, notice this: if your gross income is $5 or more, then you have to file a tax return. So basically, anybody who is filing married, filing separately, is going to have to file a tax return. Then if you are head of household, you can see that it is $21,900 is the minimum amount of income to file a return. And if you are a qualified surviving spouse, then it is $29,200. Again, not coincidentally, that is the same as the married filing jointly amount. And because, as you'll learn, a qualifying surviving spouse gets essentially the same benefits as those who are married filing jointly. These amounts, when we get to the video about the standard deduction, you are going to recognize these amounts because that's what these amounts are. So for a single taxpayer who is under age 65, their standard deduction is $14,600. Therefore, if they have got less than that in income, then they don't need to worry about filing a tax return because they are not going to owe any income tax. So that's what these amounts represent. So what about those people that are not most taxpayers? Who is that? And when do they have to file a return? Well, the people that do not use that chart is anybody who can be claimed as a dependent on someone else's tax return. So, for example, a child that can be claimed as a dependent on their parents' tax return would not use that previous chart. Instead, they would look at this one. So, let's zoom in here and look more closely at this. At the top here, it's basically saying if you can be claimed as a dependent, then you need to use this chart instead of the other one. And then it just explains the various types of income that we already talked about: earned, unearned, and gross income, and what those amounts mean. So let's look at this. If you are single and you are a dependent on someone else's tax return, then you're going to use this top box here. So then the question is, are you 65 or older or not? If you are not, so this would be the stereotypical minor child who is a dependent on their parents' tax returns. So they are under 65, they are not married, so they are single, so this would apply to them. That person needs to file their own separate tax return if any of the following apply. If they had unearned income of more than $1,300, so remember that's interest, dividends, etc. If they had earned income of more than $14,600, you'll recognize that number from the previous chart. So maybe this is the 16-year-old who has a part-time job and they've got earnings from that. Well, if they have earned income of $14,600 or more, then just like everybody else on that previous chart, then they need to file their own separate tax return. And then the final category is if their gross income, so the combination of their earned and unearned income, if that gross income is more than the larger of $1,300 or their earned income plus $450, then they must file a tax return. So this third category, it sounds a little bit convoluted, but they're just trying to kind of catch the people who don't quite fall in to the unearned category of 1,300 or more, and they don't quite fall into the earned income of 14,600 or more, but they've got a combination of earned and unearned income that is large enough that they need to file a return. That's who this is talking about. So you will want to remember this for the exam, this $1,300 number, the $14,600 number, and then the larger of $1,300 of unearned income or their earned income plus $450. Then next, this is going to be the yes people are the people who are single. They're not married, but they were either age 65 or older, or they were blind. If that is the case, so this might be, for example, a parent of an adult child. So the adult child is claiming the parent as a dependent. That would be an example. Well, if that parent's unearned income is more than $3,250, then that parent needs to file their own tax return. Or if it is $5,200, if they are both age 65 or older and blind, but it's $3,250 if they're just 65 or older and not blind. They also have to file their own tax return if their earned income was more than $16,550. And yes, people age 65 or older can have earned income. And then there's the final category. If their gross income, again, the combination of their earned and unearned income, is more than the larger of $3,250 again, or their earned income plus $2,400, then that person needs to file a separate tax return. So again, this is this top box. This is for single, unmarried dependents. Then we're going to move down to the bottom box, which is for married dependents. This is not all that common, at least for younger people. It can be a little bit more common for those age 65 or older. But if you do have someone who is married, they are a dependent on someone else's tax return, then again, we're going to ask, are you 65 or older or not? If you are not, so this could be a child of the taxpayer, that child happens to be married and they happen to qualify as a dependent. So this is not a lot of people. We're going to talk later about how you qualify as a dependent, but there's not going to be a whole lot of people who are married and a dependent on someone else's tax return, but it is possible. So if you fall into that category and your unearned income again is more than $1,300, same as above for an unmarried dependent, same numbers. You're going to see 1,300, 14,600. Those numbers did not change. And again, this bottom one, the gross income did not change. So these numbers are exactly the same, whether you are a married dependent or you are a single dependent. The one difference is if they are married filing separate, then remember, if they've got gross income of at least $5 and their spouse files a separate return and itemizes deductions, then that married dependent has to file their own tax return. What if you have a married dependent who is over age 65? So this would be a little bit more common than one who is under age 65, because this could be, for example, a adult child who is claiming both of their married parents as dependents. If you have that situation, then If the married dependent has unearned income of more than $2,850 or earned income of more than $16,150, and these numbers are different than up above here. So unearned income of more than $2,850, earned income of more than $16,150. We've got that same rule about $5 if they're married filing separately, or if their gross income was more than the larger of $2,850 or their earned income plus $2,000, then that person must file their own separate tax return. Now, on the EA exam, there will definitely be questions about whether or not someone needs to file a tax return. So they may ask a question that says, Johnny is 16 years old. He is a dependent on his parents' tax return. He is single and he earns $17,000 from a part-time job. Does he need to file a tax return? And then you would say, well, yes, he does, because he had more than $14,600. So you may have those questions. Or going back to this other chart, they'll have questions here. They'll say that a particular married couple is under age 65 and they have $25,000 of gross income. Do they need to file a return? And then you would need to know that no, because it's under $29,200, they do not need to file a return. So they are going to ask those types of questions on the exam. The good news is they will typically focus on the more typical examples. So spend most of your time remembering the basic numbers, like from this chart, and then you will want to remember the basic numbers from here, a single dependent who's not married, etc. You don't have to worry so much about that they're married, they're under age 65, and then they've got this much earned and this much unearned. They don't tend to get that tricky on the exam. Not that you should ignore these numbers, but spend most of your time remembering the basic, more common situations. Next, we need to talk about those situations where you need to file a return regardless of the amount of income you had. Remember, we said you might have to file a return because you have a minimum amount of income, which is what we just talked about. But some people, regardless of the amount of income, they have to file a tax return anyway. So that's what we're talking about on this particular chart. Again, this is from publication 17. So even if you don't meet those minimum income requirements that we just went over, you must file a return if you meet any of the things on this particular chart. First of all, if you owe any of these special taxes, you have to file a 1040 regardless of your income. If you owe the alternative minimum tax, and we'll talk more about that in a later video. If you owe this additional tax on a qualified plan, such as an individual retirement account or other tax favored account, then you have to file a 1040. If you owe any household employment taxes, which we'll talk about later. If you owe Social Security and Medicare tax on tips that you did not report to your employer, or on wages that you received from an employer who did not withhold those taxes. Not a common situation, but if that happens, then you have to file a 1040. If you have any uncollected Social Security and Medicare tax on tips that you reported to your employer, or on group term life insurance and additional taxes on health savings accounts. Again, not very common, but if you have those things, then you need to file a return. Or if you owe certain recapture taxes, such as depreciation recapture that we'll talk about later, then you have to file a 1040. Next is if you or your spouse received any distributions from a health savings account or these other special types of health related accounts, then you have to file a return. If you had net earnings from self-employment of at least $400, this is one you will want to know. There will almost certainly be a question on the exam about this. So no matter how much income you had, if you had net earnings from self-employment of at least $400, then you need to file a Form 1040. Not because you'll necessarily owe income tax, but because you will owe something called self-employment tax that we will talk about later. So when we say net earnings from self-employment, again, we're going to go into this more when we talk about computing the self-employment tax. But for now, just know that net earnings from self-employment, you take your self-employment income. So you've got revenue from being self-employed, and you subtract your expenses from being self-employed. That's going to leave you with a net income. Then you are going to multiply that by this percentage. It's by 0.9235. So it's 92.35%. So you multiply your net income from your self-employment times 0.9235. That gives you your net earnings from self-employment. If when you do that, it's at least $400, then you are going to owe self-employment tax, and you have to file a Form 1040 no matter how much your gross income is. Next, if you had wages of $108.28, and yes, you are reading that correctly, if you are a church employee, so certain church employees are exempt from withholding for Social Security and Medicare taxes. So if one of those employees has wages of $108.28 or more, then they have to file a Form 1040. So hopefully, if you see a question about this on the exam, that number will jump out at you as being such an odd number, and you'll remember, oh, that's right, church employee, and they have to file a return. If a taxpayer received advance payments of the premium tax credit, then they have to file a tax return. We'll talk more about that when we talk about tax credits. Then you have this other one. This is very obscure, not likely to be questioned on the exam. But if you have these amounts under 965, which has to do with deferred foreign income, if you have those, then you have to file a Form 1040. And then finally, and this is new for 2024, if you purchased a new or used clean vehicle from a registered dealer and reduced the amount you paid for that vehicle at the time of sale by transferring the credit to the dealer, then you must file a Form 1040, regardless of your amount of income. So let's do a couple of examples of filing requirements so we can kind of get the feel for this and kind of get a feel for some of the types of questions that you might see on the EA exam. So first, Joey is 21 years old. He's single and he cannot be claimed as a dependent on anyone else's tax return. In 2024, he earned $11,000 at a part-time job, and he had dividend income of $2,500 and interest income of $1,000. Does he need to file an income tax return for 2024? Well, let's think about this. He is single and he's not claimed as a dependent on anyone else's tax return. So we're thinking about that first chart. He is most taxpayers. We use that chart. His total income was what? $11,000 from his job plus $2,500 from dividends. So that's $13,500. Then he had interest income of $1,000. So that's $14,500. Is he required to file a Form 1040? I'm sure that you got the right answer. No, he is not. His total income is only $14,500, which is less than the $14,600 minimum required to file. Now, just because Joey doesn't have to file a return, does that mean he's not allowed to file a return? No, it doesn't. He is allowed to file a return. He's just not required to file a return. Now, you might say, why would somebody file a return if they are not required to? Well, it could be a couple of reasons. First of all, let's think about that part-time job. Joey made $11,000 at a part-time job. They may very well have withheld federal income tax from his pay. if he wants to get that money back, he has to file a tax return. And of course, he's going to want to get that money back because he doesn't owe any income tax because he had less than $14,600. So if they withheld any federal income tax, he wants to get that money back. So therefore, he would want to file a tax return in order to get that refund. There could be other things as well. So there are certain credits, such as the earned income credit, the additional child tax credit, the American Opportunity Credit, the premium tax credit that you can only get if you file a tax return. And he might qualify for one or more of those credits. So in that case, he would want to file a return in order to take advantage of that. Let's move on to our second example. Monica is also 21 years old. She's also single and she cannot be claimed as a dependent on anyone else's return. She earned $11,000 as well, but she earned it in her grass cutting business. And she had dividends of $2,500 and interest income of $1,000. Does Monica have to file an income tax return for 2024? Well, on the surface, it looks a lot like our previous example, right? She's 21, she's single, she earned the same amount of money, so she's got $14,500. You might say, well, that's below $14,600, so she doesn't have to file. But wait, I'm sure you noticed that there is one major difference here, and that is that Monica earned her income not from a job, but from her grass cutting business. So that is self-employment income. And remember, if you have more than $400 of net earnings from self-employment, you have to file a return. So Monica does, in fact, have to file a Form 1040 because her self-employment earnings are $400 or more. She is not going to owe any income tax because her total earnings were less than the $14,600, but she will owe self-employment tax, so she does have to file a Form 1040. Now let's move on to the filing deadline, and I bet you already knew the answer to this one. When does the 1040 have to be filed? It has to be filed by April 15th of 2025. So for the 2024 return, it is due on April 15th of 2025. So the general rule is that a Form 1040 is due on the 15th day of the fourth month following the end of the tax year. So again, that is going to be April 15th. However, sometimes April 15th falls on a weekend or it falls on a holiday. When that happens, then the deadline is pushed to the next business day. So, for example, if April 15th is on Sunday, assuming Monday is not a holiday, then the return would be due on Monday, April 16th, instead of the 15th. But for 2024, and we are talking about the 2024 tax year for the 2025 EA exam, it is due on April 15th of 2025. Now, you can get an extension of time to file the tax return. So you can get what's called an automatic 6-month extension to file. And you get that by filing this Form 4868, and it gives you this extension to file to October 15th, 2025. And you don't have to have a good reason to file an extension. That's why it is called an automatic extension, because the IRS is not going to question it. They will automatically grant you that extension, but you do have to file the Form 4868 in order to get that extension. Now, very important to know, and you will be tested on this on the exam. Just because you get an extension to file the return, that does not mean you have an extension to pay any tax that is due. You still have to pay whatever is due by April 15th. If you don't, you will be subject to penalties and interest for not paying on time. Now, you might be saying to yourself, wait a minute, Tom, if I don't have all the information I need to look at my return, or I haven't even looked at everything yet, and I'm filing this extension, how am I supposed to know whether or not I owe any tax? Well, you're going to have to do the best you can do. You're going to have to make some sort of estimate, and pay that in with your 4868. Now, you may look at it and maybe you've got a refund due. Well, if you have a refund due, you don't have to worry about it. Just file the 4868 and you're okay. But if you are going to owe, then you need to estimate the amount you're going to owe and you need to send that in with the 4868. Now, there are some exceptions to the normal April 15th filing deadline. So let's talk about some of those. First of all is the outside of the U.S. exception. This is only for U.S. citizens or residents. So if you are a citizen or a resident of the U.S. and you are living outside of the United States or Puerto Rico, and your main place of business or post of duty is outside the United States or Puerto Rico, then you get an automatic 2-month extension of time to file your return to June 16th of 2025. Normally it would be June 15th. It's a 2-month extension, but June 15th is on a weekend, so therefore it is June 16th for 2025. So it's an automatic 2-month extension. Now, this is important, though, to know this is if you are living outside of the U.S. and your main place of business or post of duty is outside the US. This is not just that you are on a European vacation on April 15th. You do not automatically get the extension. It's not even that you're traveling on business. Let's say you're traveling on business to Australia on April 15th. Well, that does not qualify for this exception either. You need to actually be living outside the US and your main place of business is outside the US. So if you are living in Australia for work, because that's where you are now working, that's your place of business, then you would qualify for this exception. So if you meet that criteria, then you don't even have to file a form. You automatically get this 2-month extension. But again, it is not an extension to pay. So if you are going to owe, you still need to pay by April 15th. What you might do if you're going to owe, and what we usually do for clients in this situation is we just go ahead and file a 4868 on April 15th for this client. So even though it's not technically due until June 15th, you can file that extension anytime before June 15th. So we would just file the 4868 on April 15th and go ahead and send in the estimate of the amount due at that time. But let's say you don't owe any money. You think you're going to get a refund. You get the automatic extension to June 16th of 2025. You can get another 4 months out to that October 15th date by filing the form 4868. But in this case, you would file it on June 15th, and you'd only get that additional 4 months to October 15th in order to file your tax return. The next exception to the April 15th deadline is the disaster area exception. So if the taxpayer is in a presidentially declared disaster area, then the IRS will give an extension of time to file and to pay the tax. So this is not just an extension of time to file, but also an extension of time to pay. I think they figure that if you're in a disaster area, then you've got enough problems going on that they're not going to then penalize you and charge you interest for not paying by April 15th. So they will extend that time. There is not a set date in the law about when that time will be because it's going to depend on the nature of the disaster. So what will happen is the IRS will come out with an announcement that says anybody who is affected by that disaster, and they'll usually do it, they'll say if you live in a certain county within a certain state, for example, then you are considered to be in that disaster area. And so you will get an extension, and then they will announce what that date is. Maybe they'll announce that it's May 31st or July 1st or whatever, but they will tell you what that date is. This will apply to individual and business taxpayers who live in that disaster area or whose tax records are in the disaster area, and also to relief workers who are working in that disaster area. So any of those people who are affected by that disaster will get this extension of time to file and to pay. The next exception that we'll talk about, and final exception we'll talk about, is the combat zone exception. So if the taxpayer served in a combat zone as designated by the president, then they will get an extension of time to file and pay their tax. And this applies not only to military personnel, but it's also civilian support personnel as well as Red Cross personnel and certain correspondents like press correspondents who are working in the combat zone. This applies to them as well. They get this extension of time to file and pay. And here is how you determine the length of time that they have. They get a combination of these two things. They get 180 days from the later of their last day in the combat zone or their last day of a qualifying hospital stay due to being injured while in the combat zone, plus the number of days before April 15th that they entered the combat zone. So it could be up to 3.5 additional months. So let's look at an example. Nick is in the military and entered a combat zone on January 31st of 2024, and he served without injury through March 31st of 2025. When is his tax return due? His 2024 tax return is due 255 days after March 31st of 2025, which is December 11th, 2025. How did we determine that 255 days? He gets his 180 days from March 31st, 2025, plus 75 more days. The 75 days is February 1st through April 15th of 2024, because remember, he went in on January 31st of 2024. So he gets the rest of the time through April 15th added on to the 180 days. So if you're trying to do this calculation, remember that 2024 was a leap year. So February had 29 days, and then March has 31 days, and then 15 days in April. Penalties. So if you fail to file on time, so mostly we're going to be talking about people who fail to file by April 15th, but this would apply even to those people who meet an exception. They still do have a date when they have to file and pay by. So if you fail to file by the due date, then there is a penalty. The penalty is 5% of the balance due per month or part of a month, up to a maximum of 25% of the balance due. So this can go on for up to 5 months. So it's per month or part of a month. So if you are late filing by 4 months and 1 day, that is going to be treated as 5 months. So you're going to have to pay 5% for each month up to that maximum of 25%. So let's say your amount due was $1,000. 5% of that, if my math is right, is $50. And so you would owe $50 per month for 5 months. That's $250, which of course that's 25% of the $1,000. And so you would owe $250 for your penalty for failure to file. If there was fraud involved, then instead of 5%, it goes up to 15% of the balance due per month or part of a month, up to a maximum of 75% of the balance due. If your return was more than 60 days late, then your penalty is going to be the smaller of $485 or 100% of the unpaid tax. So let's say you owed $400. That's your balance due. Well, 5% of that is only $20. So let's say you were 5 months late. That's only $100. But because you were more than 60 days late, you're going to have to pay $400 as your failure to file penalty. If you had an extension, The penalties start on the original due date. So let's say you filed for your extension to October 15th, but then you didn't file by October 15th. You filed after October 15th. Well, the penalties are going to start all the way back at April 15th. So just because you got an extension to October 15th, that's not going to help you if you don't actually file your return by October 15th. You're going to pay penalties and interest all the way back to April 15th. But then, very importantly, we've been talking about percentages of the amount due. If you don't have a balance due, so if you've got a refund coming, or if it's zero, you don't have a refund or a balance due, then there is no failure to file penalty. So if you don't owe money, you don't file your return on time, then there is no failure to file penalty. Failure to pay penalty. So this is separate from failure to file. So you may have filed your return on time, but you didn't actually pay on time. You could have a failure to pay penalty. Or maybe you didn't file your return on time, and of course you didn't pay either, then you're going to have a failure to pay penalty. So this penalty is 0.5% of the balance due per month or part of a month, up to 25% of the balance due. So again, if you owed $1,000, you didn't pay it, well, 0.5% of that is only $5. So it'd be $5 per month, but it goes for as long as you didn't pay it. So it could go until you owed $250. So it could keep going. If you don't pay and you don't pay and you don't pay, $5 per month is what? $60 per year. So it's going to keep going all the way up until you owed 25% of the amount due. If you extend, if you get an extension and you pay in at least 90% of the balance due, then there will not be any failure to pay penalty. So let's say when you file your extension, you estimate that you're going to owe $1,000. So you file your extension and you pay in $1,000. But then when you actually do your return, turns out you were a little bit off and you ended up owing $1,100. That's the amount that you actually would have owed. Well, you paid in $1,000. That's more than 90% of $1,100. So therefore, they are not going to charge you any penalty on that extra $100 that you did not pay in. What they're basically saying is you did your best, you made an estimate, and it was close enough. So we are not going to charge you any failure to file penalty since you did a pretty good job of estimating how much that you were going to owe. And then the failure to pay penalty, again, is based on the balance due. So if there's no balance due, then there is no failure to pay penalty. What if you don't file and you don't pay? Well, then you have to pay both penalties. However, it's not quite as harsh as it sounds because the failure to file penalty is reduced by the failure to pay penalty, which means your combined penalty is that 5% per month that we talked about for failure to file. However, the same greater than 60-day rule does still apply. So if you're greater than 60 days late in filing, then you're still going to have that smaller of 100% of the tax due, or $485 as your penalty. Interest. If you don't pay when you are supposed to pay, the IRS will charge you interest in addition to penalties. That interest will be charged even if you get an extension of time for filing, and the interest is charged on the penalty as well. So if you don't file and or pay on time, not only are you going to get charged penalties, not only are you going to get charged interest, you are also going to get charged interest on your penalties. So this can really add up. You've got taxpayers who owe a lot of money. They could have very large penalties, and then they're going to have to pay interest on all of that as well, on the original balance due, on the penalty itself. So that can really add up. And these interest rates are based on the federal short-term rate, and they are compounded daily and updated quarterly. So what this means is, and you will probably get a question on the exam about this. They're going to ask, when are the interest rates? How are they compounded? A, annually, B, quarterly, C, monthly, D, daily, etc. So they are compounded daily. So you will want to know that. They are updated quarterly. What that means is every quarter, the IRS will publish what are the interest rates for that quarter. So they're updated quarterly, but they are compounded daily. Again, you want to know that. In some cases, the interest can be forgiven if it was due to an IRS error or delay. So we'll talk more about this in part 3 of this course. But for now, just know that it is possible that the interest can be forgiven, but it's only if it was due to an error or a delay on the part of the IRS. So it's not actually granted all that often, but it can happen. Then we also want to talk about this penalty for perjury. This will almost certainly be on the exam. Knowingly filing or helping to file a false tax return or aiding in fraud is a felony, and the maximum fine is $100,000 and or up to 3 years in prison. So this applies to the taxpayer and it applies to you as the preparer. Remember when we looked at the 1040, you had those signature blocks and we said you were filing under penalty of perjury. If you knowingly file a false return or a fraudulent return, or if you, as the preparer, help a client file a false or fraudulent tax return and you do so knowingly, then you and or the taxpayer can be guilty of tax fraud and you can go to prison for up to 3 years for each count of that, and you can be fined up to $100,000. The IRS wants to make sure that you know that it is a serious offense to knowingly file a false or fraudulent tax return. So they will probably ask you a question about this. So you will want to know this $100,000 and up to 3 years in prison. Again, we'll get much more into that in part 3 of this course. Let's talk now about the specific items in the top section of the income tax return. So this is going to have a lot of the basic information that is needed to file the return: the name and address, the dates of birth, information about their citizenship and residency, marital status, dependents, social security numbers. You're going to have all of those things. So we're going to talk about each of these things in turn. So let's just revisit that top section of the 1040 so we can remember the types of things that are asked. So you can see here at the top, we've got all your basic information about names and social security number. You can also see here at the very top, before even we get to the name, says for the year January 1st to December 31st, 2024, or other tax year beginning on blank date and ending on blank date. For individual tax returns, almost always we are calendar year taxpayers. So this is going to be a calendar year 99.99% of the time. It is theoretically possible to have a tax year other than a calendar year for an individual, but it is very likely you will go your entire career without ever seeing it. So for the vast majority of time, you will do nothing with this because it automatically defaults to a calendar year. If it is something other than a calendar year, January 1st to December 31st, then you would fill that in. Even if the taxpayer dies during the year, they still can file their return as if it was a full year return, as if it was a calendar year return. So you wouldn't even need this in that case. So it's going to be a very rare case that you would use this. So for purposes of the EA exam, forget about it. You just know that individual taxpayers are calendar year taxpayers. So we're always going to be talking about the calendar year. When we get into business tax returns, in part 2 of this, we'll talk about other types of tax years that businesses may have, but individuals don't have to worry about that. So getting that out of the way, we're going to get through all of this basic information. And then we've got a couple of check boxes. We've got one up here and we've got one down here about digital assets. We'll talk about those later. Then we get to this filing status. So we're going to go into detail about each of these, but you need to check what your filing status is. And then we're going to get down to a standard deduction. So we'll talk about standard deduction versus itemized deductions in a later video. But if you're taking the standard deduction, then you would check the appropriate boxes here. Then we get into your age. And so this is asking, were you born before January 2nd of 1960? What they're trying to get to is, are you age 65 or older or not? That's what these check boxes are trying to get to. But notice, were you born before January 2nd of 1960? So in other words, were you born on January 1st of 1960 or before? If you think about it, if someone was born on January 1st of 1960, then on December 31st of 2024, they were 64 years old. They were not yet 65 years old. But what you're going to find when we talk about a person's age at the end of a year, frequently the IRS gives you one extra day. So that if you were born on New Year's Day, if you were born on January 1st, then they will consider you to have been born on December 31st. So that's what they're saying here. If you were born on January 1st of 1960, then you can check this box and you are going to get credit for being age 65 on December 31st of 2024. Then they also have a box here for if you are blind, then you would check it. Then there's one if you are married, then you would check the same for your spouse. So what you're going to do is when you fill this out, if you're married, filing jointly, one spouse is going to be named first, and then the other spouse is going to be named second. It doesn't matter which spouse is named where, but the first person listed, when they say you, that means the first person listed. And when it says spouse, that means the second person listed. So you would check those boxes if they are age 65 or older or blind. And then we're going to get down to the dependents. So you see, if you've got dependents, then you need to put their name, their social security number, what their relationship was to you, and then you need to check these boxes if they are eligible for certain credits. So this is what we talk about when we're talking about the top section of the tax return, and now we're going to look at some of these things in more detail. So first, we're going to look at the social security number. So it's the SSN or the TIN. So everyone on the tax return has to have either a social security number or a taxpayer identification number known as a TIN, a TIN or a TIN. They have to have one or the other. The vast majority of people are going to have a social security number, so that's what you're going to have. So the taxpayers themselves, you have to put their social security number, and any dependents, you have to put their social security numbers. The only time a dependent does not have to have a social security number is if you have the unfortunate situation of a baby that was born and died in 2024. In that case, you do not have to have a social security number, but any other dependent does have to have a social security number or a taxpayer identification number. So there are certain people who will not have a social security number and cannot get a social security number, but still need to either file a tax return or be claimed as a dependent on a tax return. So if you have that situation, then that person needs to file for an individual taxpayer identification number. So this would be for a non-resident or resident alien who is not eligible for a social security number. They would file for this ITIN, this individual taxpayer identification number. This includes children, and dependents, because remember, you have to put their number on the return as well. You get this I-10 by filing this Form W-7 with the IRS, and it is used for tax purposes only. So it can't be used for identification or for anything else like that. It is only for use with the tax return. The other class of individuals who may not have a Social Security number is a child who is in the process of being adopted. So the taxpayers in the middle of adopting a child, they cannot get the Social Security number until the adoption is final, but that child might still qualify as a dependent on that taxpayer's tax return. So if they have that case, then they can file Form W-7A with the IRS and they can get that ATIN, that adoption taxpayer identification number. So remember, most taxpayers going to have a Social Security number. That is what you need, except for these exceptions where instead you will have a taxpayer identification number. Let's talk next about tax residency. We've already talked a little bit about this, about resident aliens and non-resident aliens. So what does all of that mean? So for purposes of the tax law, an alien is any non-U.S. citizen. So if you're not a U.S. citizen, then you are considered an alien under the tax law. And there are three types of aliens: resident aliens, non-resident aliens, and dual status aliens, which is a mixture of the two, of resident and non-resident. So let's talk first about resident aliens. If you are considered a resident alien, then you are going to be taxed just like a U.S. citizen, which means you are taxed on your worldwide income. So if you are a U.S. citizen or you are a resident alien, then you are going to be taxed on your income no matter where it comes from, whether it comes from the United States or it comes from outside of the United States. You are taxed on that income as a U.S. citizen or resident alien. An alien is going to be considered a non-resident by default. So you are a non-resident alien unless you meet one of the two tests to be considered a resident alien. Those two tests are called the green card test and the substantial presence test. So you will want to remember that for the exam. Again, the default is to be a non-resident, but if you meet either of these two tests, then you are a resident. And from a tax standpoint, it's actually better to be a non-resident. Why? Because if you are a resident alien, you are taxed on your worldwide income. If you are a non-resident alien, as we'll see later, you are not taxed on your worldwide income. You are only taxed on your U.S. source income. But in any case, you are considered a non-resident unless you pass one of the two tests. So first is the green card test. You meet the green card test if you are a lawful permanent resident at any time during the tax year. If you are a lawful permanent resident, then you will have a permanent resident card, also known as a green card due to its color. So if the taxpayer has a green card, then they are a resident alien. And this is one of those things that you would want to get a copy of. So when you're talking to the taxpayer and they say, yes, I'm a lawful permanent resident, then you would ask for a copy of their green card and you would get a copy of that. So that's the first one. That's pretty straightforward. Either they have the green card, they are a lawful permanent resident, or they do not have the card. And so that's how you know if they meet that test. The next test is the substantial presence test. So even if they don't have a green card, they could still be a resident alien if they meet the substantial presence test. In order to meet this test, they must be physically present in the United States on at least 31 days during the year. So we're talking about 2024 here. So they have to have been physically present in the United States for at least 31 days during 2024 and 183 days during the 3-year period that includes 2024 and the 2 years immediately before that. However, it is not just 183 days, the way you would normally count days. You have to count those days in a special way. And so the way you count those days is you count all of the days that they were present in the current year, so in 2024. So every day that they were present in the United States in 2024 counts towards this 183 days. But we only count 1/3 of the days that they were present the year before. So that would be 2023. And we only count 1/6 of the days that they were present in the year before that, which would be 2022. So you count all of the days, 2024, 1/3 of the days in 2023, and 1/6 of the days in 2022. So let's look at an example. Bjorn was physically present in the United States on 120 days in each of the years 2024, 2023, and 2022. So we know that he meets this first test, which is 31 days during 2024. He was physically present for 120 days in 2024. So definitely meets this first test. So the question is, does he meet this second test for the 183 days? So how do we determine that? We count the full 120 days in 2024. We count 1/3 of the days in 2023. So 1/3 of 120 is 40 days. And we count 1/6 of the days in 2022, and 1/6 of 120 is 20 days in 2022. So when you add that together, it's 120 plus 40 plus 20. That's 180 days. So 180 days is less than 183 days. Therefore, Bjorn is not considered a resident alien for 2024. He would be a non-resident alien for 2024. So what does it mean to be a non-resident alien? Well, as we hinted at earlier, a non-resident alien is taxed only on their income from sources within the United States and on certain income connected with the conduct of a trade or business in the United States. So I'm just going to call that United States source income. So non-resident aliens are not taxed on their worldwide income. They are only taxed on their U.S. source income. So, for example, if you have a non-resident alien and they've got a bank account in France, which is where they're from, and so they have interest on that bank account. They're a non-resident alien. That interest on that French bank account is not taxable for United States tax purposes. If they are a resident alien and they have that same bank account, then that interest that they earned on that French bank account would be taxable on their U.S. tax return. So that's the difference between a resident and non-resident alien. For either of them, if they've got a bank account in the United States and they have interest, either way, resident or non-resident, that will be taxable in the U.S. A non-resident alien may be required to file a Form 1040-NR, and we're going to look at that here in a minute. You don't have to go into the specifics. You're not likely to be asked a question on the exam about the 1040-NR, so don't worry about all of the requirements and all of that for filing it. I just want you to know that it exists and that these non-residents may need to file it. There's a special case for a non-resident alien spouse. So if a U.S. citizen or resident alien has a spouse who is a non-resident alien, they can choose to treat that spouse as if they were a resident alien. So in other words, you can file a joint return with your spouse and you consider that spouse to be a resident alien if you choose to. The IRS is okay with this. Why? Because again, the resident alien is going to be taxed on their worldwide income. If they were a non-resident alien, it would only be their U.S. source income. So the IRS is either going to be ahead of the game or they're going to break even if that non-resident alien spouse chooses instead to be taxed as a resident alien. So let's look quickly at that 1040 NR. The NR is for non-resident. So you can see just at first glance, it looks a lot like the 1040. So we will zoom in here and you can see it really is a lot like the regular 1040. It's got a lot of the same basic information. You can see here though that it can also be filed by an estate or a trust as well as an individual, but it's got most of the same types of information. It's got the income that's effectively connected with the United States, and you've got all of those things that you would put in there. It gets down to your adjusted gross income, just like a 1040, and then deductions, etc. And then we go to page 2. And you can see again, it's got the tax and tax credits, payments that were made, refund or amount due. So it looks a lot like the 1040, but it does have some different requirements about what is included. And remember, this is for non-resident aliens, which means it is only going to include US sourced income, not worldwide income. Let's now talk about this last status, which is a dual status alien. So it is possible to be a non-resident alien for part of the year and a resident alien for part of the year. So usually this happens either in the year of arrival to the United States or the year of departure from the United States. For the part of the year that they are a resident alien, they are taxed on their income from all sources, from worldwide income, just like any other resident alien. And what counts is when that income was received. So if they have income from sources outside the United States, if they received that while they were a resident alien, then it is taxable. If they received it while they were a non-resident alien, then that income would not be taxable to them because it comes from outside of the United States. For the part of the year that they are a non-resident alien, then they are taxed only on their income from U.S. sources. So really, the dual status alien is pretty easy to understand once you understand the difference between a resident alien and a non-resident alien. It's just that they are one for part of the year and the other part of the year. So while they're a resident alien, they are taxed on all of their worldwide income. While they are a non-resident alien, they are taxed only on their U.S. source income. That's what it means to be a dual status alien. So let's just do a quick recap of this topic. Remember, what's an alien? It's any non-U.S. citizen. 3 types: resident alien, taxed on worldwide income; non-resident alien, taxed only on U.S. source income; or a dual status alien, which is a combination of the two. And for more information, check out publication 519. Now let's talk about filing status. We've already mentioned these before, but here they are. There are 5 different filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying surviving spouse. This used to be called a qualifying widow or widower. So if you've been around a while, you might remember that, but they changed the wording in 2022 to qualifying surviving spouse. So if you're out Googling around, sometimes you may still see references to qualifying widow or qualifying widower, but just know that it is now called a qualifying surviving spouse. Also, you'll see these abbreviations, S, MFJ, etc. Get used to those because it's a lot easier to put the abbreviations on the slide than to write this out each time. So you are going to want to familiarize yourself with those abbreviations and what they stand for. So we're going to talk about each of these and who qualifies. Single. Single means you were not married on December 31st, 2024. So anytime we're talking about marital status, what counts is your status on December 31st of 2024. So you are single if you were not married as of December 31st, 2024. So you could have been married for all of 2024, but your divorce becomes final on December 31st of 2024. You are considered single for 2024. Single also includes if you were widowed before 2024. If you were widowed during 2024, then you are considered married for 2024. But if you were widowed before 2024, then you are considered not married during 2024. However, you may qualify for a different filing status, either qualifying surviving spouse or head of household, as we will talk about. Married filing jointly. To file married filing jointly, you must have been married on or before December 31st, 2024. Because remember, you are considered married all year. So if you were single all year, you got married on December 31st, 2024, you are considered married for all of 2024. And this is true even if your spouse died during the year. You are still considered married on December 31st, 2024. Also, both spouses must agree to file jointly. If either spouse does not want to file jointly, then you cannot file married filing jointly. If you file married filing jointly, you report your combined income and allowable expenses. You are considered to be one taxpayer. You are married filing jointly, you are one taxpayer, which means both spouses are both generally going to be liable for any tax that is due. You sign the tax return, you are liable for that tax. Both spouses are equally liable. So the IRS can go after either or both spouses for the money. There are sometimes exceptions to that we'll talk about later, but that is the general rule. Married filing jointly usually has more favorable tax treatment than married filing separately. What you can do is you can run it each way. If you've got good professional level tax software, usually you can choose to run it both ways. In other words, you can say, let's see what they would owe if they are married filing jointly, and let's see what they would owe if they were married filing separately. And then you can compare the two and take whichever is most favorable. What you are going to find is most often it is most favorable from a tax standpoint to be married filing jointly. We'll talk later about some of the times that you might want to file separately anyway. Then also, if you are married filing jointly, and this is important to know for the exam, you cannot amend to file separately after the due date for the return has passed. So once April 15th has passed, if you file married filing jointly, you cannot later amend to file married filing separately. So if you're going to file jointly, you want to make sure you're okay with that because you're not allowed to change it later. Now let's talk about married filing separately. In order to qualify for married filing separately, again, you must have been married on or before December 31st. For this, each spouse files their own tax return with only their own income and expenses, and each spouse is liable only for their own tax return. So you are not liable for the taxes of your spouse if you are filing separately. Again, this is often less favorable tax treatment than married filing jointly, and you cannot elect to file single. So you can't just say, well, instead of filing married filing separately, I'll just file single. That is not allowed. If you were married on December 31st, 2024, then you need to file as a married person, whether you are married filing jointly or married filing separately. There is one minor exception to that we will talk about here in a little while, but for the vast majority of time, if you're married, you have to file as a married person. With a married filing separately return, you can amend it to file jointly if you change your mind later. So again, you're going to want to know this for the exam. If you filed married filing jointly, you cannot amend to file married filing separately. But if you originally filed married filing separately, you can amend later to file jointly as long as you do so during the normal amendment period, which is usually 3 years from the original due date. Next filing status is head of household. To be head of household, you have to be unmarried on December 31st, 2024. You can also see this considered unmarried. So let's set that aside for a moment. We'll talk about that. But for now, you have to be unmarried On December 31st, 2024, you have to pay more than half the cost of keeping up a home for the year. You have to have a qualifying person that lives with you in the home for more than half the year. Now, they do not count temporary absences against you. So in other words, let's say you've got a single parent and their child lives with them, but their child is in college. So they're off out of town in college for a part of the year. That will not be considered against them. As long as their home is still the parent's home, then they will be considered to have lived in that home even for that time that they were away in college. Then also, it's important to note here, if the qualifying person is a dependent parent. So, head of household, it does not have to be your child that is living with you. It could be another qualifying person. That qualifying person could be your parent, who is a dependent of yours. The parent, does not have to live with you in order for you to qualify as head of household. So, for example, the parent may live in a nursing home, and that's fine. That will still qualify for head of household as long as all of the other requirements are met. The benefit of head of household is it is a lower tax rate and a higher standard deduction than either single or married filing separately. So it's not quite as good as married filing jointly or qualified surviving spouse, but it is better than being single or married filing separately. So it's kind of in between. So they're saying, okay, you're not married. However, because you've got this person living with you, we're going to give you a bit of a break. And so that is what head of household does. So let's talk about this considered unmarried and what does that mean? Well, you'll be considered unmarried, even if you actually are legally married, if you meet all of these following tests. You have to file a separate return. You have to have paid more than half the cost of keeping up the home. Your spouse did not live in the home for the last 6 months of the year. And here, the temporary absences work in the other direction. You don't get to count temporary absences as meaning the spouse did not live in the home for the last 6 months of the year. So if the spouse was out of town on business for the last 6 months of the year, but their home was still your home, then you don't get to count as being unmarried. In other words, it doesn't count as them not living with you for those last 6 months. They just happen to be out of town. So they have to actually have a separate residence for at least the last 6 months of the year in order to qualify as being unmarried. Next, the taxpayer's home was the main home for their child, stepchild, or foster child for more than half the year. So here, another person other than the child does not count. So we're talking about being considered unmarried. We're not talking about qualifying for head of household. These are two separate tests. Remember, you can qualify for head of household even if the person that's living with you is not your child. But if you want to be considered unmarried, that person who's living with you does, in fact, have to be your child. And then finally, the taxpayer must be able to claim that child as a dependent. So not only does it have to be your child, but you have to be able to claim that child as a dependent. However, if you could claim them as a dependent, but you don't, because of something called the tiebreaker rules. So sometimes the non-custodial parent will get to claim the child as a dependent because of something called the tiebreaker rules that we will talk about later. But if the taxpayer could have claimed the child as a dependent, except for those tiebreaker rules, then they can still meet this considered unmarried test. Cost of keeping up a home. So when we talk about head of household, remember the person had to pay more than half the cost of keeping up a home. So what does that mean? The cost of keeping up a home means the rent, mortgage interest, real estate taxes, homeowners insurance, repairs, utilities, in food that's eaten in the home, so not food out in restaurants, but food in the home, is considered part of the cost of keeping up the home. It does not include things like clothing, education, medical treatment, vacation, life insurance, transportation, or value of services that were provided. So those things, at least the clothing, education, medical treatment, those things may count as part of support. So when we talk about dependence later, that might count for whether or not you are supporting that person for dependency purposes. But for cost of keeping up a home, those things do not count. It's only the things specifically related to the home that count as a cost of keeping up a home. So now let's talk about a qualifying person. Remember, in order to qualify as head of household, you have to have a qualifying person that lives with you. So let's talk about what a qualifying person is. There are 3 categories of qualifying persons: a qualifying child, a qualifying parent, or other qualifying relative. So a qualifying child, so this would be a son or daughter, or even a grandchild who lived with you for more than half the year and meets certain other tests. So it's a qualifying child or grandchild. If that child is not married, they are single, then they are a qualifying person automatically for purposes of head of household. If they are married and you can claim that child as a dependent, they are also a qualifying person. The only time a child will not count for head of household status is if they are married and you cannot claim them as a dependent. So again, not going to apply to very many people. But if you have that case, they are not a qualifying person. So basically, if you have a child or a grandchild that lives with you for more than half the year, that child is going to qualify as a qualifying person, unless they're married and you cannot claim them as a dependent. Next category is qualified parents. So if that person is your father or your mother and you can claim them as a dependent, then they are a qualifying person. If you cannot claim them as a dependent, they are not a qualifying person. So that's a pretty easy one to know. If it is a parent, either they are a dependent or they are not. If they are dependent, they are a qualifying person. If they are not a dependent, they are not a qualifying person. And remember, if they are your parent, they do not have to live with you for more than half the year. The third category is other qualifying relatives. And it gives examples such as grandparent, brother, sister, who meet certain tests. So for this test, they have to have lived with you for more than half the year, and they have to be related to you in one of the ways listed under this special list. It's called relatives who don't have to live with you, but that's just the name of it. Don't get hung up on the don't have to live with you part. That's not the issue. That's just the name of the list, and we will go over that list later. But for now, just know they have to be listed on this special list called relatives who don't have to live with you. And you have to be able to claim them as a dependent. So if they're on this special list, they lived with you for more than half the year, and you can claim them as a dependent, then they are a qualifying person. These last 3 boxes here are actually redundant. They're saying the same thing that this box says. So first it says, if your relative did not live with you for more than half the year, then they're not a qualifying person. Well, we already said that up here. They have to have lived with you for more than half the year. Then it says, if they're not on that special list of relatives, then they don't qualify. Well, we already said they have to be on that special list. And then it says if you cannot claim them as a dependent, then they're not a qualifying person. But we already said that you have to be able to claim them as a dependent. So really just know what's in this top box here, and you will understand this third category. So those are the people who
are considered a qualifying person for the head of household test. So if you meet all of the tests for head of household, then you get that special head of household status. Next filing status is qualifying surviving spouse. This is designed for a widow or widower who has at least one dependent child. And what it does is it allows that person to use the married filing jointly tax rates and standard deduction, even though they're technically not married. It applies for the 2 years following the year of death. So if the person died in 2024, they would be considered married still in 2024. They would not be a qualifying surviving spouse. But if they meet the criteria, they could be a qualifying surviving spouse in 2025 and 2026. For the year of death, as we said, they will file either married filing jointly or married filing separately. So here are the eligibility rules. First, they had to have been entitled to file a joint return with their spouse in the year of death, even if they didn't actually file jointly. So they may have filed separately, that's fine. As long as they were entitled to file a joint return, then they can qualify as a qualifying surviving spouse if they meet the other criteria. Secondly, their spouse must have died within the last 2 years, so within either 2022 or 2023, and they have not remarried by the end of 2024. If they have remarried, then they have to file either married filing jointly or married filing separately with their current spouse. Next, they have to have a child or a stepchild and can claim them as a dependent. Notice it has to be a child, so it can't be, for instance, a parent that they are claiming as a dependent. It has to actually be a child. And then there is this exception that says they could have claimed them as a dependent, but they weren't allowed to be for one of these reasons that is listed here. I wouldn't spend too much time worrying about that, just be generally familiar with it. The main thing to know here is that they had to have a child who is a dependent or qualified to be a dependent, except that they met one of these exceptions. The next test is that the child lived in the taxpayer's home all year. And again, we do not count temporary absences against them. And the taxpayer has to have paid more than half the cost of keeping up the home, just like we talked about for the head of household. So if they meet all of this criteria, then they would qualify as a qualified surviving spouse, and they would get the benefits of the married filing jointly standard deduction and tax rates. So when we are looking at the various tax statuses, this is the hierarchy from most beneficial to least beneficial. So you've got 1 and 2 here are actually equal, married filing jointly and qualified surviving spouse. Next best is head of household. Next is single. And then finally, we have married filing separately is the least beneficial from a tax standpoint. So if you have a taxpayer, they could qualify for more than one filing status. So if they qualify for both qualifying surviving spouse and head of household, you would choose qualifying surviving spouse because it's higher up on that hierarchy. If they qualify for both head of household and single, then you would choose head of household. If they qualify for both head of household and married filing separately, remember they can be considered unmarried for the year, so they could qualify for both potentially. So then you would choose head of household. As we said before, married couples are usually going to be better off from a tax standpoint with married filing jointly. However, there can be non tax reasons that people might want to file married filing separately. So, student loan repayment programs. There are some student loan programs where the government will actually pay off your student loan for you if you are in certain professions. Whether or not you get paid back is dependent partly on how much money you earn. When they look at that, frequently they will look at your income based on your tax return. If you are married filing jointly, they will look at your total income, including your spouse's income. But if you are married filing separately, then they will only look at the income on your separate tax return. So a person might be able to save more in student loan payments than they could save in tax by married filing jointly. So they may choose to file married filing separately for that purpose. Also, there could be a case where one spouse is taking very aggressive tax positions or just committing tax fraud, and the other spouse doesn't want to get involved. So they want to file separately so they don't have to worry about that. Sometimes the spouses are in the middle of a divorce where they just don't trust each other, so they want to file separately. And sometimes the spouses just want to keep their finances separate for their own reasons. And that's perfectly fine. They are allowed to do that. Remember, both spouses have to agree in order to file married filing jointly. If one of them does not agree for any reason whatsoever, then they would file married filing separately. So let's look at a couple of filing status examples. Carol was divorced in 2023 and has two young children with David, her ex husband. In 2024, the children lived with Carol for more than half the year, and Carol paid the cost of maintaining the home. But per the divorce agreement, David claimed the children as his dependents. Does Carol qualify for head of household filing status? Well, let's think about it. She was not married, so that's the first thing. She's unmarried. She did have qualifying children that lived with her for more than half the year, and she did pay the costs of maintaining the home, but she doesn't have the children as dependents. But remember, an unmarried child does not have to be a dependent in order to be a qualifying person for head of household status. So therefore, Carol does in fact qualify as head of household. The children are qualifying persons for Carol, even though David claimed them as dependents. So this is actually a pretty common situation. You've got a single parent. They have primary custody of the children. They're maintaining the home for the children, but the other parent gets to take the children as dependents on the tax return. Well, that single parent where the children live still qualifies as head of household. Next, Eduardo's wife Maria died in 2023. 2024, he's still single and he is raising his two young children alone. He's paying all of their expenses and he is claiming them as dependents. Since he is unmarried and he is providing a house for the children, a friend of Eduardo's advised him to file as head of household. Should Eduardo follow his friend's advice? Well, let's think about it. Does he qualify as head of household? Well, yes, he's unmarried because his spouse died in 2023. So seems like it. He's got two young children. Those are qualifying people, pays all their bills. They live with them. So yes, he does qualify as head of household. So Eduardo's friend seems like maybe they're onto something here. But should Eduardo follow his friend's advice? Well, I'm sure you've figured out by now, maybe Eduardo actually qualifies for an even better filing status than head of household. Maybe he qualifies as a qualified surviving spouse. So let's think about it. Maria died in 2023, so that's 1 year before. He's not remarried. He's got two children. They are dependents. Sounds to me like Eduardo qualifies for a qualifying surviving spouse, which is better than head of household. So the answer to our question is no. Eduardo should not listen to his friend. Eduardo needs to find a good enrolled agent to do his tax return and point out to him that he can qualify as a qualifying surviving spouse, which is a more favorable tax status than head of household. So now let's talk about dependents. We've talked about whether or not someone is a dependent several times already. So what does it mean to be a dependent and to qualify as a dependent? Well, the term dependent means a qualifying child or a qualifying relative. So you will want to know that for the exam. And that sounds pretty straightforward, qualifying child or qualifying relative. But we're going to find out it's not quite as straightforward as it sounds, as is true with a lot of things in the tax law. But one important thing to know is that it does not include housekeepers, maids, or servants who work for the taxpayer. And so, yes, that means at some point there were people trying to take their housekeepers, maids, and servants as dependents. So the IRS had to come out and explicitly say those people do not qualify as dependents. So remember, to be a dependent, you need to be a qualifying child or a qualifying relative. So, what does that mean? So, we have another chart. Again, this is from publication 17. So, what it says at the top here is that there are certain people you cannot claim as a dependent. So, first of all, you cannot claim any dependents if you yourself could be claimed as a dependent by another taxpayer. And it does have this exception, which says that the only reason that that person that claimed you as a dependent filed a return was in order to get a refund of amounts withheld or estimated taxes paid. But the main rule you want to remember is if you can be claimed as a dependent on someone else's tax return, then you cannot claim any dependents yourself. Next, you cannot claim a married person who files a joint return as a dependent unless that joint return is only filed in order to get a refund of amounts that are already paid in. So, again, the main rule you want to remember is that if someone is married filing jointly, then you cannot claim them as a dependent. Next, you cannot claim a person as a dependent unless that person is a United States citizen, a resident alien, a U.S. national, or a resident of Canada or Mexico. So they have to fall into one of those categories in order for you to claim them as a dependent. And you cannot claim a person as a dependent unless that person is your qualifying child or your qualifying relative. And of course, that is the definition of a dependent, is that they are your qualifying child or your qualifying relative. So it only makes sense that you cannot claim someone as a dependent if they don't meet those qualifications. So what does it mean to be a qualifying child? Well, I'm going to zoom in here a little bit to make it a little bit easier to see. In order to be a qualifying child, the child must be your son, your daughter, stepchild, foster child, brother, sister, half brother, half sister, stepbrother, stepsister, or a descendant of any of them. So remember, I said it's not quite as simple as it seems. So a qualifying child does not necessarily even have to be your child. It could be your brother or your sister, or it could be your niece or your nephew. And of course, it could be your actual child in one form or another. But that's the first test, is they have to be in one of those categories. Secondly, the child has to be either under age 19, meaning they have to be 18 or younger. So they have to either be under age 19 or under age 24 and a full-time student. And also, it says they have to be younger than you. So if you're dealing here with your brother or your sister, that person has to be younger than you. But the main rule here is that they are under age 24 and a full time student. Then the other thing they could be is any age if they are permanently or totally disabled. So just remember this: they have to be under age 19, so 18 or younger, or under age 24 and a full time student, or permanently and totally disabled, no matter what their age is. Next, that child, to be a qualifying child, must have lived with you for more than half the year. And again, we don't count those temporary absences against them. The child must not have provided more than half of their own support. And the child must not be filing a joint return for the year. Again, we talked about that up there. Anybody who is filing a joint tax return for the year, you cannot claim them as a dependent, even if they are your qualifying child. And then there is that exception that if the only reason they filed that joint return was to get a refund of amounts paid in, then that's okay. So these are the tests to be a qualifying child, so you will want to know those for the exam. Next is a qualifying relative. So remember, the person has to be either a qualifying child or a qualifying relative. So the first rule to be a qualifying relative is they cannot be your qualifying child or the qualifying child of any other taxpayer. So if the person's not your qualifying child, but they are the qualifying child, say, of your ex-spouse, then they cannot be your qualifying relative. So they cannot be a qualifying child for anyone. Secondly, they have to be on that special list that we talked about that we will look at here in a little while. Or if they weren't on that special list, they must have lived with you all year as a member of your household, and the relationship must not violate local law. So, what are we saying here? In order to be a qualifying relative, you don't necessarily have to actually be a relative. As long as that person lived with you all year as a member of your household, even if they weren't related to you in any way, they can still be a qualifying relative as long as they meet all of the other tests. Next, the person's gross income for the year must be less than $5,050. So that's gross income has to be less than $5,050. And then the last thing we have here is that you must have provided more than half of the person's total support for the year. So let's think about a stereotypical example of this might be a child who is not related to the taxpayer, but the taxpayer is taking care of that child. Maybe there was some sort of tragedy with the parents or some sort of situation where the parents aren't in any shape to take care of the child. And so a family friend has taken that child in and is caring for them. So even though the child's not related to them, they would still be able to take that child as a dependent as long as they meet all of these tests. So now, finally, you say, finally, we're going to see this list they've been talking about of relatives who don't have to live with you. So this is that special list that we said for various circumstances the person needs to be on. So they are related to you in one of the ways on this list. And the list looks kind of intimidating and busy at first glance, but if you look at it kind of big picture, it's not that hard. First of all, they could be your child in one form or another. So that's pretty easy to remember. If they're your child, they're on the list. They could be your sibling in one form or another. They're on the list. It could be your mother or father or a grandparent. They're on the list. Even a stepmother or stepfather on the list. They could be a niece or a nephew. They could be an aunt or an uncle, or they could be an in law, either a son in law, daughter in law, father in law, mother in law, brother in law, sister in law. So, any of those. So, again, if you think about it, it's close relatives, a child, a sibling, a parent, a grandparent, a niece, a nephew, an in law. Those are the people who count as a relative who is on this list. And then finally, what we say here is any of these relationships that are established by marriage do not end due to death or divorce. So once someone is your mother in law, they're always your mother in law, even if you end up getting divorced. Once someone is your stepchild, they're always your stepchild, again, even if you end up getting divorced or if the other parent dies. They still count as your stepchild or as your in law. So that's what we are saying. So you will want to know this for the exam. But again, just think about it in big categories. Don't worry about memorizing every word and every exact relationship. So the support test. Remember, we said for a qualifying relative that the taxpayer has to provide that relative's support. So what does that mean? Well, they have to provide more than half of that person's total support. Total support includes amounts spent to provide food, lodging, clothing, education, medical and dental care, recreation, transportation, and similar necessities. So all of those things are included when we're talking about support. Lodging is based on fair rental value. In other words, what would that person, the dependent, have to pay to get similar lodging somewhere else? You can use that fair rental value when you're determining whether or not you provide more than half of that person's total support. And that relative's own income and funds count toward their support only if it's actually used for the support. So they could have $1 million in the bank, but if they don't use that $1 million for their support, then it does not count towards their own support. Let us do a couple of examples for dependents. George's wife, Marilyn, died in 2022. In 2024, Marilyn's mother, Mabel, lived with George, and he provided virtually all of her financial support. Her only income was $5,000 in Social Security, which she donated to her church. Can George claim Mabel as a dependent? Well, what do you think? Let's think about it. Is Mabel on the list? Well, she was a mother in law. Mother in law is definitely on the list. However, remember, his wife died 2 years ago in 2022. So does Mabel still count as George's mother in law? And of course, you know the answer. Yes, she does, because those relationships do not end due to death or divorce. So Mabel does count as his mother in law. He's providing all of her support. She does not have more than $5,050 of income, and she's not using that money to support herself. So the answer here is yes. George can claim her as a dependent. Next example. Patrick and Irene have healthy twin sons living at home, John and Joe. They are 20 years old and single at the end of 2024. Patrick and Irene support both of them. John is a full-time college student. He earns $15,000 at a part-time job. Joe is unemployed, not in school, and only earned $1,000 house sitting for some friends while they're on vacation. Maybe Patrick and Irene need to have a conversation with Joe about what he's going to do with his life. But in any case, it is what it is. So the question is, can Patrick and Irene claim John as a dependent, and can they claim Joe as a dependent? So let's talk about John first. That's the easy one. John is 20, so he's over age 18, but he is under age 24 and he is a full-time student. Now, he does earn $15,000 at a part-time job, but that's not relevant to the question because we already said that Patrick and Irene support him and he lives with them. So the fact that he earned that money at a job is not relevant for purposes of determining whether or not he is a dependent. So we do know that John counts as a qualifying child. He is under age 24. He is a full-time student. He counts as a qualifying child. Therefore, Patrick and Irene can claim John as a dependent. So now let's talk about Joe. Is Joe a qualifying child? Well, he is over age 18 and he is not a full-time student. Therefore, we know that Joe does not qualify as a qualifying child. So does that mean that Patrick and Irene cannot take him as a dependent? Well, we don't know yet because remember, there's two ways that a person can be a dependent. They can either be a qualifying child or a qualifying relative. So does Joe count as a qualifying relative? Well, first of all, he cannot be a qualifying child. Is he a qualifying child? No, we've already established that. So we're good there. Next, he has to be on that special list of relatives. Is he on that list? Well, yes. Remember, the very first thing on that list is a child of the taxpayer. So he's on the list. Then they have to have provided more than half his support. They did that. He cannot have more than $5,050 of gross income. We only had $1,000. So sounds to me like he does count as a qualifying relative, and that is the answer. They can claim him as a dependent because even though he's not a qualifying child, he is a qualifying relative. So you will want to remember two tests, qualifying child and qualifying relative. If they meet either of those, then they can be a dependent. Multiple support agreements. If two or more people provide the support of a qualifying relative, you can have what is called a multiple support agreement. So, this most often is adult children who are supporting one or both of their parents, and they're all sharing in the costs of supporting that parent. Those children, what they can do is they can enter into a multiple support agreement and they can agree who is going to take the dependency exemption. So, as long as the person who's claiming the dependent provides at least 10% of the total support of that parent or those parents, then they are eligible to claim the parent as a dependent. So, what happens is, let's say you've got three adult children who are caring for a parent, they're caring for their elderly mother and they're all sharing the costs. And maybe the mother lives in a nursing home and they're all helping to share those costs equally. What they can do is decide who each year is going to take mom as a dependent because any person can only be taken as a dependent once per year. Can't have more than one person claiming them as a dependent. So the children in this case can agree who's going to take mom as a dependent. And they could rotate each year. So maybe one takes one year and the other the next year and the other the next year, etc. They can decide how they want to do that. And the IRS will go ahead and honor that agreement. In order to do that, though, the others who are not taking the parent as a dependent for that year will sign this consent form, this form 2120. Divorced or separated parents. So, when you've got divorced or separated parents, there can often be disagreements about who is going to claim the children as dependents. So, we have to have a way of figuring that out. So, usually the custodial parent will claim the child as a dependent. And the custodial parent is the one that the child lived with for the greatest number of nights during the year. So, we look at overnights. So, where was the child overnight for the greatest number of nights per year? That parent is the custodial parent. They are the one who claims the child. However, the custodial parent can agree to let the non custodial parent claim them instead. So sometimes it'll actually be part of a divorce agreement that they'll let the custodial parent do it, or they'll rotate one year, one parent will take the child, the next year, the next parent will take the child. So if they have some sort of agreement like that, then the IRS will honor that. Or it may not be in the agreement, but on any given year, the custodial parent may agree that, okay, this year I'm going to let you take the child as a dependent instead. And in that case, they fill out this form 8332 or a statement similar to 8332 that says, I give you permission to take the child as a dependent. Or instead of the 8332, if you have an older divorce, so it was a pre 2009 divorce, then you can just attach the pages of the divorce decree. You don't need the form. If the divorce was after 2009, then even if it was called for in the divorce, you still have to have the form 8332 filled out. And the non custodial parent then attaches that to their tax return because they're the ones taking the dependency exemption, even though they don't have custody of the child. What this does is it allows the non custodial parent to get the child tax credit. So it used to be that you got an exemption for each of your dependents. Well, we don't have that anymore. It might come back. We may have exemptions again in the future, but for right now, for 2024, there is no dependency exemption. So the benefit is the non custodial parent gets the child tax credits. However, it does not qualify them for head of household status or to take dependent care benefit credit or exclusions or for the earned income credit. The custodial parent still gets all of those things. The only thing the non custodial parent gets in this case is the child tax credit. And we'll talk more about all of those things in later videos. Qualifying child of two or more people. So, as we said before, only one person can claim any particular child in any particular year for any of these things, for the child tax credit, for the head of household status, the child care expense credit, exclusion of income for dependent care benefits, and the earned income credit. So two people cannot claim the same child for any of these things. So what do we do if one child qualifies for two or more people? We have to have tiebreaker rules, and we referred to these earlier. First of all, if only one of the people is the child's parent, then the parent wins. So maybe you've got a parent the child qualifies for and a grandparent on the other side that the child qualifies for. The parent would be the one that gets to take the child in that instance. If both parents try to claim the child, then it goes to the one that the child lived with for most of the year. So we already talked about this. It goes to the custodial parent. However, what if the child lived with each parent equally? Well, in that case, it's the parent with the higher adjusted gross income. So the higher AGI wins in that case if both parents qualify. They both had the child equally. If neither parent can treat the child as a qualifying child, then the person with the highest adjusted gross income wins. So let's say the parents don't qualify, but grandparents on either side do. So you've got grandparents on the father's side, grandparents on the mother's side. They're trying to figure out who gets to take the child. We look at the higher adjusted gross income. That is who wins in that case. If no parent claims the child, then it's the person with the highest adjusted gross incomes. However, there's a proviso here. As long as their AGI is higher than any of the parents who can claim the child. So, what are they talking about here? It seems pretty convoluted. So, what you could have here is a high income taxpayer who is the parent of the child. The child tax credit gets phased out the more money you earn. So if you have a parent who earns quote unquote too much money, if there is such a thing, but if they earn so much money that the child tax credit is not going to do them any good, then what they might do is say, you know what, I'm not going to take this child as my dependent. I'm going to let the grandparents take the child as a dependent. That way, then the grandparent could take the child tax credit. And so what the IRS is saying is, no, you can't play these games, because what this high income parent might do is let the grandparents do it. Grandparents get the $2,000 child tax credit, then they just give that $2,000 right back to their son. And so the son has gotten around the child tax credit income phase out rules by playing games with the dependent. And so the IRS is saying you are not allowed to do that. So what they're saying is, if the person who claims the child, if their AGI is not higher than a parent, then they can't claim the child as a dependent. The parent has to claim the child in that instance. Now let's move on to our last topic, which is the check boxes, and it is a quick topic, so we are almost finished. There are two checkboxes, as you'll recall, on the 1040. The first is the presidential election campaign, which says check here if you or your spouse, if filing jointly, want $3 to go to this fund. Checking a box below will not change your tax or your refund. So this is a box that they can either check or not check. As it says, if you check the box, it doesn't mean that you owe $3 more, that you get $3 less of a refund. It just means that $3 of your taxes that you're paying will be allocated to this special presidential election campaign fund. And each spouse can decide independently, if they're married filing jointly, whether or not they want $3 to go to the fund. If you don't check it, then the money won't go to that fund. And in the real world, very few people actually check these boxes, but they can if they want to. The next checkbox is for digital assets. So the IRS is still trying to get their hands around all of this Bitcoin and digital assets and tokens and all these things. So they want to make sure that taxpayers are properly reporting these things. So they make you check a box, yes or no, answering these questions. At any time during 2024, did you A, receive as a reward, award, or payment for property or services, or B, sell, exchange, gift, or otherwise dispose of a digital asset or a financial interest in a digital asset? And you must check either yes or no. And remember, everything you're doing on the tax return is under penalty of perjury. You're signing that return. So you have to make sure you either check it yes or no. And if you did have any of these transactions, you want to make sure that you check yes. If you are talking to your client and they tell you they did not, and you don't have any reason to believe they're lying to you, then it's fine. You don't have to worry about it. Just go ahead and check no. If you happen to know the client, you know that they did have these transactions, well, that's a different matter. Then you need to check the box yes. And if the taxpayer has a problem with that, then frankly, you need to not do their tax return. You do not want to sign that tax return if they are lying. And if they want to check that box no, and you know that they did have these transactions, then they are lying. You do not want to sign that tax return. So you want to talk to the taxpayer and just explain to them, hey, look, you don't want to lie about this. You could go to prison for that. Usually they'll fall in line and go ahead and agree for you to go ahead and check that box. Yes. And that, my friends, is the end of video 1 of part 1. Only 19 more videos to go. As with all of these videos, go back and watch any parts of it or all of it as many times as you need to. Study the slides. And I do thank you for joining me on this journey, and I will see you in video 2.